Brigid, of course, we have seen the rand weakening against the dollar, particularly over the last week or so, trading around 777, 778 this afternoon. On a trade-weighted basis, we're still looking pretty robust. How much would a weaker currency help our economy at this stage?
I think that if you look at the statements that have come out of the Reserve Bank, specifically around the MPC, one of the main statements that have been, has given rand a slight boost is the fact that it's been something that has positively impacted the inflation expectations and certainly kept inflation on the lower end of the band and possibly even push it even lower. So I think from that perspective, it seems to feel as though the Reserve Bank is behind the levels of the rand at these current levels, despite the pressure that they're getting from the likes of exporters in the local markets.
Michael, very good afternoon to you. I know that you lean more towards a more stable currency in terms of some kind of intervention. Could you give us an indication of what your strategy is, why you think it would be a good idea for the South African government to have a more controlled currency?
Well, I think that we live in a very different age from the one that we've been in before. And I think that economics needs to be updated for the world that we do live in now. And I think the evidence of everything that's going on in Europe at the moment is fairly strong in that respect. I've long believed that a developing country like South Africa with 40% unemployment should be looking much more as to what is necessary in order to get its economy moving and employment being created than simply relying on tried, tested and now largely failed policies which were made in the West for the West.
Do you think we should be pegging the rand? At what level do you think would make us more competitive, Michael?
Any level lower than the current level by definition would make us more competitive. I'm very careful about what I say when I say pegging the rand. If we were to peg the rand, and I'm not completely convinced that that's politically possible, but if we were to peg it, I think it would be extremely unwise if we pegged it while still at the end of it running a current account deficit. I do not think, looking at what's happened in Asia and other parts of the world which have pursued pegged currency policies, that pegging the currency at a rate that would still ensure that we run a current account deficit would be a good policy.
Brigid, the counter-argument, of course, is the fact that we don't have enough reserves. We have a very volatile currency, and the fact when we do weaken, we weaken quite extensively. So there's a danger to that happening as well. And many are expecting the rand to weaken anyway towards the end of 2010.
I think there's a couple of factors that we need to keep in mind. Number one, our currency per se is not under attack. So we're not in the same situation that you're seeing in Europe, where there's a lot of speculation around the currency. That's the first thing. I think that in terms of emerging market levels, we're quite well, we trade quite evenly within a current range, and that's maintained for the whole duration of the last year. I think on top of that, what we really want is we want to create an environment where we can fight our budget deficit, where the entire global market is looking at countries that are running a deficit and how they're managing those deficits, and the sterilization or the opportunity to either support the rand, defend the rand, or peg the rand is very, very costly exercise, specifically coming from South Africa. If you think that you're having to issue bonds to generate rand at 7% and your next best carry is at 3%, that is a huge amount of money that you're going to have to outlay in order to defend something that ultimately is actually beneficial to the economy in terms of the fact that it keeps inflation low. Because if you look at the growth curve that we had between sort of 2003, 2007, there were three factors. We had lower inflation, we had low interest rates, and we had a fairly leveled traded rand. So those are the levels that we want to try to maintain. We want to create an environment where inflation is well within the target band, interest rates remain low for a longer period of time. And that ultimately will benefit everybody within our economy. Also, one last thing I just want to throw in is keeping in mind that our productivity in South Africa isn't as robust as what you're seeing in the likes of China, etc. So you are certainly not, you've got much more weighted or should I say there's much more negativity coming from the impacts of the import inflation rather than what you're seeing if you've pegged the rand purely just to make your exports a little bit more competitive. When on the flip side of that, you're having wage negotiations that are going through at 3 times inflation rates. Those are things we should rather be talking about rather than the levels of the rand.
Michael, inflation in target
interest. There.
Okay.
There are 3 things. First of all, don't worry about reserves if you're running a current account surplus. This is a red herring. We just are very sensitive to it because during the 1990s we tried to defend the currency while still running a current account deficit. As I said before, the psychology required is for us to move into a world where we think about what would it be like to run a current account surplus. So the whole issue of reserves is a red herring used by many people who basically don't understand the basics of economics. The second thing to say is productivity is measured finally in an international unit of account like US dollars. And our productivity is indeed not as good as China, in part because we are not as competitive as China. And one of the mechanisms for narrowing that competitive disadvantage, which we currently face, is precisely to do so through the exchange rate. And thirdly, I think that we need to understand that inflation is not necessarily our primary concern at the moment. I'm much more concerned about the idea that we have 40% unemployment. When I hear those who defend inflation targeting, incidentally, a philosophy which is now broadly rejected by the chief economists of Goldman Sachs, Morgan Stanley and HSBC, when we hear people defending inflation targeting, I never hear anything coming out of them as to what we are what we should do to fundamentally address the issue of 40% unemployment in South Africa.
Of course, Brigid, we know that inflation hurts the unemployed the worst because they have no money and they can't afford the higher prices. But how about the arguments, well, the red herring that was thrown just on having reserves not really matching as long as if you're running a current account surplus?
Well, I think that we are in a situation where we run a deficit, and that's something that we need to be aware of. We were in a better position because we were running a surplus when we went into this crisis and the onset. If you look at what the global economy is talking about, I'm very sorry, but one of the main reasons that we're in the situation we're in is because deficits were not managed, and the outcome of those are the very situation that we're sitting in Europe. So as much as that's being said, I still buy into the policy that we need a completely separate monetary policy that is contained within the Reserve Bank. One of their mandates being inflation targeting. I think that that's beneficial to the entire economy. If you're worried about job creation, you better worry about the fact that importers run a lot of risk in terms of the fact that if you peg the currency and the ramifications of that, or deflating where the rand's currently trading, what the ramifications and the run on unemployment could possibly do. With respect to what we're seeing specifically around the unemployment, I don't buy into the whole unemployment thing purely because I think that that has so many other factors that influence it, not necessarily the rand levels.
Michael, just looking at the kind of signal that it would send to foreign investors, and I think some would argue that a weakening currency, when you have an inflation target of between 3% and 6%, which is exactly what we have, will bring about over time obviously imposing on taxes as well in terms of foreign capital inflows. What is your view on this? Do you think that it could be one of the big risks to South Africa?
I'm very much along sync here with the thinking of the central banks of India, Brazil and Russia at the moment, and they are starting to question the idea that there are certain forms of foreign investment that aren't necessarily good for your country, and particularly here we're talking about what's called hot money, foreign portfolio investment. And there is a catch-22 here. If we persist in running a deficit, yes, then we do need to attract foreign investment inflows, which then goes back to my prior point. Yes, but if we ran a surplus, we wouldn't need to worry about these things and we would not be a hostage to their considerations. It requires a complete rethink of our economics. And I'm afraid the problem with a lot of people in South Africa is that they just don't really understand how, for instance, economies in Asia have been running. When I mentioned to a friend of mine at the Central Bank of China, who had 2 PhDs in the subject of inflation targeting, what did he think about the relevance of inflation targeting in developing countries, he looked at me with a smile and said, "Inflation what?" I think that there is a completely different school of thinking out there at the moment, and we need to get up to date with the arguments. We need to get ourselves out of the old stale thinking that was essentially made in the West for the West and which is now coming a cropper in the West. And incidentally, on the issue of deficits, there are 2 forms of deficits. There are budget deficits and there are current account deficits, and both are important. And one of the problems that we're facing at the moment is that, yes, Europe itself as a region, as a monetary zone, is running a current account deficit. The UK is running a current account deficit. the United States is running a current account deficit, and that conditions their entire monetary policy. Once you put yourself of running a current account surplus, you are in a very different space, and you have a very different set of parameters that you need to be thinking about. Inflation targeting is a subject which I have written passionately about, I've spoken in Parliament about, and I really question whether it is an appropriate policy for South Africa, a country whose labour market is not clearing to the tune of 40% unemployment. I fully accept that exchange rates are not the magic silver bullet that will solve all problems related to unemployment. I've said that all along. But people who believe that somehow that we can solve the problem of unemployment without addressing the fact that our currency is so mispriced relative to the true economy that exists in South Africa, and that I mean all the people in South Africa, the 100% of people in South Africa, not just the 60% who are lucky enough to be in employment or have someone within their family employed, then I think that we have a completely different economic argument which we need to face. At the moment, we're kidding ourselves.
But Brigid, is our currency mispriced? Because if you look at it over the longer term, it has been on the same path, hasn't it?
I think it has been, and I think with regards to looking at hot money or bringing funds in from offshore, then you've got to pose the argument that if we have a weaker currency, which ultimately will have an inflationary implication, which therefore relates to higher interest rates, you will be attracting much more hot money. Specifically in this environment,
so
where
more carry trade coming on.
With more, that sort of flow. Is that necessarily what you want? Not necessarily so, but it is part of the way that we run the economy. It's something that we need to fund the deficit that we're currently running. It's not huge, and it's not, if you look in the past, in the terms of the volume of hot money that we saw, I think that is depleted quite significantly. I think that the rand is trading at fair levels. Comparatively, the ranges that we've seen have signified that, in fact, if you look at anybody that's an emerging market trader offshore, they deem rand to be relatively well managed and well maintained within a quite a tight band, specifically for an emerging market. I think in terms of the Chinese argument, what concerns me a lot is that for them, inflation is in fact a massive implication. If you look at what we're talking about of it boiling out of control, or putting measures in place that then start to manage that drain on the economy so that we don't see these house prices, inflationary pressures pushing through, I don't buy into the fact that inflation is not an issue for the likes of Russia, Brazil and China. I think that it is a very real issue. I never said that inflation...
Just a second. Let's get this argument out straight. I have never, ever said that inflation is not an issue. The problem is that people assume that if you cannot weaken the rand, that inflation is the only issue. It's not the only issue. And there are plenty of people out there in the emerging markets where I spend a lot of my time. I'm off to Argentina and Mexico next week. I'll be in China later this year. I'll be in India later this year. I was in Russia earlier this year. I can assure you the arguments that are happening in the central banks there are none of the arguments that I tend to hear happening from our central bank here.
Okay, Michael,
we live in a Western world here in South Africa, and we need to understand that the whole dynamic that's governing the global economy is starting to shift.
Michael?
And we need to move with the arguments. China does not ignore inflation. China is extremely sensitive to inflation. Of course it is. But I can assure you, in terms of the conduct of their monetary policy at the moment, the issue of the exchange rate is more important at the margin to them than the issue of inflation.
China's inflation target for 2010 is around 3%. Our inflation target band is between 3 and 6%. Where would you like to see inflation here in South Africa? I mean, where you don't see it at dangerous levels, but yet again, we don't have that target band.
Sorry, where would I like to see inflation? You're asking me the wrong question. Where would I like to see unemployment? A lot lower than it is at the moment.
Right.
And Brigid, just looking at the tools, perhaps, for instance, if we were to argue that we should weaken the currency, I think Michael did mention, obviously we fought against the wind a few years ago when Chris Stals was still the governor. We built up that massive net open foreign position defending the rand. I think he mentioned perhaps Brazil, where they've put speed bumps in place, taxing some of that hot money. What are some of the tools we could use if we did want to see the rand weaken a little bit?
Well, like you've mentioned, those are two of the main tools. What we then could do is also issue bonds into our local market and invest in US treasuries, for example. Unfortunately, all of these have a massive cost implication. And that's why I'm saying, as RMB, we are totally against any form of pegging of the rand. purely because what ends up happening is that you cannot control your own monetary policy. You import monetary policy from another state. And is that really what we need? When in fact, our monetary policy has been very, very well maintained and has been something that has been commended from global counterparts. So I think that in terms of the bigger picture, I think that one of the major obstacles, and this is not a South African issue, this is a global issue. He's right, unemployment is a massive problem. This is something that's not just huge in South Africa, this is huge in Europe, it's huge in the United States. They're running all-time unemployment levels. What are we going to do to combat that? We have to create a facility whereby we can grow an economy. One of the main growth engines will be to facilitate opportunities for consumers and business. And how you do that is that you create business, so you make them competitive, you lower inflation, you keep interest rates low for a prolonged period of time so that people have money that they want to spend. Business feels confident. People want to invest. Those are just the basics, I mean, as we all know. I'm just saying that the more stable the outlook, the more confident that you are in your country. If you look at what's happening in Europe currently, they're talking about putting regulation, putting rules in place. Immediately you can see the sell-off. Why? Because it's negative around the sentiment for that state. You're viewing a situation and saying, they're not sure how to manage themselves, so now they have to put rule and regulation. They have to peg the currency. They have to defend their currency because they don't deem that the market knows what the actual value of that is. And I think that that is where you run the massive risk. Market must be able to control the levels up to obviously, if there's massive speculation, what we were talking about earlier in terms of the naked selling, that's a different story altogether. But in terms of South Africa, we are not being targeted in terms of where our currency is trading. In fact, if anything, I think that our currency has been very, very well traded.
Michael, just
a little point of correction there. Brigid said that we have been commended globally. We've not been commended globally. We've been commended out of the West. I have to say, being commended by the West at the moment for monetary policy is not something I take as a compliment. I think their monetary policy is in disarray. All four major Western, if I include Japan in the definition of West, central banks are involving themselves in quantitative easing on an extraordinary scale at the moment. What President Sarkozy calls monetary dumping. They basically, in the UK last year, they monetized 100% of debt issued by the United Kingdom government. In the US, they monetized 40% of the debt issued by the United States government. In Japan, they monetize 100% of the debt issued by the Japanese government. Those guys are not playing by the book in any way or form. And just to pick up on Brigid's earlier point, we have not been commended globally. We have been commended by the West.
Michael,
if you go to India, if you go to Brazil,
Michael, on
if you
that note,
go to Russia,
we have to leave it
if
there.
you go to Russia, they are not commending us for our monetary policy.